Hey everyone, Joe here from Avalon Accounting. In this video, we're covering the important things that Canadian business owners need to know about GST and HST. This is one of those topics that's often misunderstood, but once you get the basics down, it starts to make more sense. We'll walk through what GST and HST are, when and how to register, how it works, and how to file your returns without pulling your hair out. So let's dive in. So let's start with the basics. What exactly is GST and HST? In Canada, GST stands for Goods and Services Tax. It's a federal tax that applies across the country. HST stands for Harmonized Sales Tax. It's used in some provinces where the federal GST and the provincial sales tax are combined into one tax at a single rate. The rules for how GST and HST work are basically the same, but the rate you charge depends on where your customer is located. So here's how it breaks down. In provinces like Alberta, there's no provincial sales tax, so you just charge the 5% GST. In provinces like Ontario and Nova Scotia, HST applies at a higher combined rate. In provinces like BC and Saskatchewan, you charge GST, and then provincial sales tax may apply separately depending on what you're selling. So we'll go over how to figure out what rate to charge a bit later. But for now, just know that GST and HST are both forms of the same sales tax that you may need to collect and send to the CRA. Let's take a closer look at how GST and HST actually work. When you make taxable sales, you charge GST or HST to your customers. The tax isn't actually your money, you're collecting it on behalf of the government. At the same time, you'll probably be paying GST or HST on your business expenses. The good news is that you get to recover the tax by claiming something called input tax credits, or ITCs for short. Here's the general formula. GST or HST collected on your sales minus GST or HST paid on business expenses, also known as the input tax credits, or ITCs. This equals the amount that you send to the CRA. So let's say you collect $1,400 in GST or HST from your customers. During the same period, you pay $500 in GST and HST on business expenses. You subtract the $500 from the $1,400, and that leaves you with a $900 owing to the CRA. If the situation is flipped, where you paid more GST or HST on expenses than you collected on sales, you would get a refund. So now that we know what GST and HST are and how they work, the next big question is, when do you actually need to register and start charging it? Most businesses in Canada don't have to register for GST and HST right away. There's a small supplier threshold that gives you a bit of breathing room. If your total worldwide taxable sales are $30,000 or less over the last 4 consecutive calendar quarters, you're considered a small supplier, and that means registration is optional. But once your taxable sales go over that $30,000 mark in a 12-month period, registration becomes mandatory. Taxable sales include pretty much everything a typical business earns unless it's specifically exempt. And that includes things like selling products, providing services, collecting rent from commercial tenants. Exempt sales are things like residential rent, certain medical or dental services, and some financial or educational services. These are exceptions, not the rule. So for most businesses, your regular sales count towards that $30,000 threshold. Let's say your sales looks like this: Q1, $5,000, Q2, $5,000, Q3, $10,000, and Q4, $10,000. That adds up to $30,000 over 4 quarters. If you make another sale after that, you're now required to register and start charging GST or HST on the next sale. Now, even though you're under the threshold for GST and HST, you can choose to register early. Now, why would you want to do that? Well, one big reason is that once you're registered, you can start claiming back the GST or HST you pay on business expenses. These are called input tax credits, and we'll talk more about those in the next section. Voluntary registration can be helpful for startups or growing businesses that are spending more than they're earning early on. All right, so you know when you need to register and how GST and HST actually work. Now let's go over how to get you registered. The easiest way to register is through CRA's online business registration portal. It's quick, straightforward, and can be done in just a few minutes. You can also register by mail or by phone if you prefer, but online is usually the way to go for most business owners. Before you start, make sure that you have a few key details ready. Your business name and address, your contact information, a short description of what your business does, your expected annual revenue, your fiscal year, and your social insurance number if you're a sole proprietor, or your business number if you've already registered a corporation. Once you've submitted the application, you'll get a GST and HST account number and you're officially registered. From that point on, you'll need to charge GST or HST on your taxable sales and file regular GST and HST returns based on your filing frequency. Once you're registered for GST or HST, the next step is figuring out how much tax to charge your customers. This depends on what's called the place of supply. Place of supply is just CRA's way of saying where your customer is located or where they're receiving the goods or services. The place of supply determines whether you charge GST at 5% or HST at a higher combined rate, depending on the province. Let's look at how it works using a few simple examples. So let's say you run a business in Alberta and you're selling something to a customer in Alberta. Alberta doesn't have a provincial sales tax, so you would just charge a 5% GST. Now let's say you're based in Ontario and your customer is also in Ontario. Ontario is a participating province, so you would charge 13% HST on the sale. What if you're still in Ontario, but your customer is located in Alberta? Since the customer is a non-participating province, aka they don't have HST, you would charge 5% GST even though your business is located in Ontario. In each of these cases, the tax rate is based on where the customer is located, not where the business owner is located. For online sales, the same rule applies. You charge based on the customer's location. This is especially important for things like digital downloads, virtual services, or e-commerce sales. Even though the transaction happens online, you're still responsible for charging the correct rate based on where the buyer lives. If you're selling to a customer who is outside of Canada, you don't usually have to charge GST or HST. These are called zero-rated supplies, which means they are taxable, but the rate you charge is 0%. So you still get to claim input tax credits on related expenses, but you don't collect tax from the customer. This typically applies to goods that are shipped outside of Canada, services provided to non-residents, digital products or subscriptions sold to customers in other countries. Once you're registered and ready to charge GST or HST, there are a few key things to make sure you're doing correctly. It's not just about adding tax to the total. You also need to issue proper invoices and keep records that meet CRA's requirements. This one is important if you're charging GST or HST. You need to include your GST or HST registration number on every invoice that you send. This lets your customer, especially if they're a business, claim input tax credits on the tax you've charged them. The registration number should be easy to find and clearly labeled. You'll usually see it written as GST HST number followed by a 9-digit business number with the account extension, which is usually RT0001. Your invoice should break out the GST or HST you've charged separate from the price of the product or service. For example, let's say you're in Alberta and your sales subtotal is $1,000. Your next line would be GST at 5% broken out, so that is $50 of GST. Then you would show the total at the bottom of the invoice for $1,050. If you're charging HST, you can just show it as a single amount and label it clearly as opposed to splitting it up into federal and provincial portions. If the above example was sales in Ontario, it would show a subtotal of $1,000, HST at 13% of $130, and a total of $1,130. You also need to keep a record of every invoice you send out. CRA requires that you retain these records for at least 6 years in case of an audit. Whether you use accounting software or a manual system, make sure that you're tracking the date of the sale, the customer name, description of what was sold, amounts charged, GST or HST collected, and your GST or HST number. These details will help you stay organized and make your life easier when it's time to file your return. Once you've registered and are collecting GST or HST, you'll need to file a return to let the CRA know how much tax you've collected and how much you paid on expenses. Your return shows two main things: how much GST or HST you collected from your customers how much GST or HST you paid on business expenses, known as input tax credits, and the difference between those two amounts is either what you owe the CRA or what the CRA owes you as a refund. There are a few ways to file your GST and HST return. The easiest option is through CRA's My Business account. You can also use NetFile if you've been given a 4-digit access code on a letter. Some accounting software will let you file directly through the app. Now, once you're logged in or set up, the return itself is pretty simple. You'll be asked for the total sales during the reporting period, excluding tax, total GST or HST collected, total input tax credits or ITCs you're claiming, and the net tax, which is the difference between what you collected and what you're claiming. If you collected more than what you paid, you'll pay the difference to CRA, and if you've paid more than you've collected, you'll get a refund. If you owe money after filing your return, you have a few ways to pay. You can pay through online banking, which is just like paying a bill, CRA's My Payment service, pre-authorized debit, or by mailing a check, though that does take longer. If you're getting a refund, you can have it deposited directly into your business bank account, or the CRA will send you a check. How often you file your GST and HST return depends on how much revenue your business brings in each year. There are a few options, so it could be monthly, quarterly, or annually. And the CRA assigns your minimum filing frequency based on your total taxable revenue. Here's how it breaks down. If your annual revenue is $1.5 million or less, you can file annually. If your revenue is between 1.5 million but less than 6 million, you need to file quarterly. And if your revenue is over $6 million per year, you'll have to file monthly. That's your default, but if you'd rather file more frequently than required, you can. For example, some annual filers choose to file quarterly or monthly to stay on top of their cash flow. Now let's talk about due dates because they're not the same for everyone. Monthly and quarterly filers have to file their return and pay any balances owing 1 month after the end of the reporting period. For example, if your period ends June 30th, your return and payment is due by July 31st. Annual, corporate, and partnership filers have 3 months after the end of the fiscal year to file and pay. So if your annual filing period ends on June 30th, your due date is September 30th. Annual filing sole proprietors follow different rules completely. Your GST and HST return is due June 15th, but any amount owing has to be paid by April 30th. Keeping track of your deadlines will help you avoid late filing penalties and interest charges from the CRA. Before we wrap up, I wanted to give a quick message on the GST and HST quick method. Now, the quick method is an alternative way to calculate how much GST or HST you owe. Instead of tracking the exact amount of tax you pay on every business expense, you just apply a fixed percentage to your total sales and remit that amount. It's designed to save some time and reduce paperwork for service-based businesses that don't have a lot of expenses with GST or HST on them. This method isn't right for everyone, but it can be a great fit for some small businesses. We've written a full breakdown to help you figure out if it makes sense for you. You'll find a link to that article in the description below. All right, so that covers the basics of GST and HST for Canadian business owners. We looked at what GST and HST are, how they work, when and how to register, how to charge and file, and a quick look at the quick method. It can feel like a lot at first, but once you understand the flow of collecting the tax, tracking your expenses, and filing your return, it becomes a regular part of running your business. If you would rather not worry about sales tax, you can reach out to us at avalonaccounting.ca, and we would be happy to help you stay on top of things there. Thanks for watching, and we'll see you in the next video. Cheers.